when it's low resistance liquidity runs. I'm going to explain what that is, okay? 5, 4, 3, 2, 1, and if you have the ability to go down to the less than 1 minute candlesticks, do that. And you'll see a lot of back and forth, the overlapping of the ranges. Once it creates a run, it comes right back over top of it. That is high resistance liquidity run conditions. That means that you're going to get chewed up, spat out. You're going to either blow your account, blow your combine, go into severe drawdown, or full tilt and be afraid to do anything the rest of the day. And because that happened to you yesterday, you're going to be fearful of taking the trades when it's like it is today, when it was low resistance liquidity run, where you don't have a whole lot of give and take and back and forth. It's just find me a PD array, get in it, go. Gone in 30 seconds. Okay, so what I defined in here, and I'll kind of walk you through this. This is pre-market, pre-session. If you look at the high here, there, that high is this rotation and then start to move all the way back down into this area in here. So what I identified is the body of the first high here, and this was like a stop hunt. So I ignored that. So I'm looking at this reference point here as the low, and it comes back down and hits it here. So pre-market, that means before 9:30's opening bell, 8 or 10 minutes after 8, okay, you're in a macro. So what's it going to do? It's going to spool, trading all the way back down, booking price down to the low over here. If we can define that range, okay, once we have that, we can calibrate that to whatever the high and the low is at the time. Once it retraces back down to a discounted rate and starts to move higher, what is it doing right there on that price run? It cleared this high. If you're really, really bullish, you can use this short-term high here. That's a shift in market structure. But here, this really nails the deal and says, okay, we've had 2 periods or 2 points of reference where the market traded above a short-term high. And then it gravitates right back down into order block, buy side imbalance, sell side inefficiency, range high, range low. With those 2 reference points, and we're bullish, and we're expecting a large range day, and we're expecting that it's most likely not going to see, if we have a large opening range gap, we're not going to see what? Much, if at all, of a retracement into the opening range gap, because it's going to be go, go, go. It's Friday, doesn't have a lot of time. It's got to run aggressively for that buy side liquidity in the 600s. So because all those factors coming together like a perfect storm, it's beneficial for you to try to start looking for setups before 9:30. What we're seeing here is the quadrants that is grading this dealing range from the high down to that low. Now think about it. Yesterday, I took your attention and told you to start focusing on the relative equal highs where everything was left smooth in the marketplace. That's our bias, is bullish. So that means we're going to be looking for draws on liquidity for buy side. We're not interested in shorts. So that means you're going to look for bullish order blocks. It means you're going to look for bullish breakers. It means you're going to look for bullish fair value gaps, or you're going to look for fair value gaps that were initially characterized as what would be short selling or premium that's going to be broken and then treated as an inversion fair value gap. You see how everything changes to, these are usable PD arrays. These are reference points that now you can suddenly build an idea or an expectation around, versus every down closed candle should be an order block. It's not. It's not. So at 8:30, the algorithm kicks in whether there's news or not, but we had medium impact news driver this morning. So at 8:30, the market trades into our discount array, and then we wait for what? Displacement. We don't just go down here and start buying just because it's trading there. Let the algorithm tip its hand to you. Let the market say, listen, I'm going to show you what I'm about to do. Pay attention. So the market goes above the short-term high here. What makes this candlestick important? It's lower high here and it's lower high here. So that's a swing high. So when the market breaks above that, that's a shift in market structure. And then it displaces higher. And then we have another swing high. This candlestick's high is lower than that one, and then the lower high on this one. So there's a swing high there. And it broke both of them, leaving what? This buy side imbalance, sell side inefficiency. A portion of the order block or a portion of the fair value gap must, listen folks, listen, okay? It must be at or below the quadrant level. Here's your lower quadrant level. Here's your fair value gap. Is this fair value gap at or below the lower quadrant? Yes. That means that this fair value gap is a proper candidate to be long when you're bullish. When time, 8:30, spooling at 8:30, that's the only 30-minute delineator for a macro. Everything else is 3:15 to 3:45 for the last hour trading, and then you have the first 10 minutes to the top of the hour and the first 10 minutes after the top of the hour. That's every hour macro. Okay, so there's your little skinny on the macros. But 8:30, whether there's news or not, the algorithm will start spooling. If it doesn't start spooling and running, then you just simply wait because it's telling you that it's waiting for the 9:30 opening bell. So what happens if you're anticipating something here and just meanders around or goes lower? Do nothing. Sit still and wait for the 9:30 opening bell. But because I built the case around everything I'm talking about today, see, we're already inside of the equivalent of 2 chapters in a book just with this live stream. Just this live stream talking about the impacts of knowing how to use the economic calendar, knowing how to use the day of week phenomenon, understanding the pools of liquidity and the PD array matrix, and how to now use that information and define which order block, which fair value gaps are the one I trade off of, because that's the one the algorithm is going to use. That's authorship. That's fingerprints, okay? By defining this with the quadrant level here, your fair value gap or order block, which is this down closed candle right there, is that below that quadrant level? Yes. Yes. Is this fair value gap at or less than this quadrant level of this dealing range? Yes. Now watch what happens. The market trades down. We have a little bit of a mohawk. That's fine because you have an order block there. That order block right here. Why am I using that one? Because it has the lowest down close in with a body. So the body's projection lower, it's lower, and we don't use this wick. This is your order block right there. So half of that order block is a mean threshold reference point. It's not consequent encroachment. Consequent encroachment is gaps or inefficiencies or wicks. Okay. When it's a candlestick body, in this case it's a bullish order block, half of that range is mean threshold. That price is 452.75. What's the low of that candlestick? The fucking low of 452.75. Folks, that's perfection. So the market does what? It rallies back up, and look what it does. It delivers into this volume imbalance. See that? So this volume imbalance, it delivers it. What's it missing? Buy side and sell side delivery. So it lays a body up in there. So it buries a body inside that volume imbalance and then drops right back down into what? That swing high here. Rallies back up, leaves the lower quadrant, trades up to equilibrium. Meanders around in here and then causes what? Another displacement. What is this candlestick right there? What is that? It's a fair value gap. Well, ICT, why didn't you use this one? Why didn't you use that fair value gap, ICT? Why aren't you using that? Because isn't that a fair value gap? Isn't that a buy side imbalance, sell side efficiency? Ain't that the thing? Ain't that the thing? No, because where's that? The majority of the body of that buy side imbalance, sell side efficiency is what? Above that quadrant. Uh-oh. Starting to make sense now, isn't it? So here we have what? Equilibrium. We're at that precipice where if you're building a position in all this down here, pyramiding, like you've seen me do many, many times, we're at that halfway point of that dealing range. So that means you have to do all of your business at that price range here or less if you're going to be pyramiding. Otherwise, if you start adding up in here or above it, you're really just tossing good money after potentially you might see a retracement. Even though it's low resistance liquidity runs, meaning that we're not getting a whole lot of deep retracements. What's a characteristic of low resistance liquidity runs? Down closed candles will support price higher, and inefficiencies will leave a portion open. High resistance liquidity runs are going to see a lot of give and take back and forth, and every fair value gap will be closed in. Remember, if it's spending a lot of time in the inefficiencies, what is it doing? It's telling you what? We're inside of high resistance. That means it's going to be problematic for you. You're not going to be comfortable in it. It's going to be back and forth price action. Don't run your stop loss up real quick to break even. Just let it move or don't trade. That's the characteristics with it. So in here, we are in close proximity to equilibrium from the dealing range high, dealing range low. We've already accumulated down here, rallied up, equilibrium, retracement, and then displacement here. So we are seeing this fair value gap dead in the middle, consequent encroachment. We can now take that also. So because it's laying inside of equilibrium and half of that gap is basically overlapping that blue line, which is equilibrium of the dealing range, when you're bullish, how could you use that? Now you can try to put a limit order to buy right at the midpoint, trusting that it's going to leave the lower portion open. Notice how it left this down here open? What is that? It's a breakaway gap. This is a tradable fair value gap. But because the consequent encroachment of this gap, it's overlapping with the equilibrium price point or middle of the high to that low. So it's a convergence of two factors of equilibrium or midpoint. So this is where a institutional order flow entry drill would be optimal, because you would expect what? Only a partial entry into that blue shaded area or fair value gap. So this is institutional order flow entry drill. Or you can use the upper quadrant of this range, and that would be done like this. And you would use that price plus one tick, that 462 3/4 plus one tick. And that would be your entry. That would basically give you a very specific, not a zone entry, a very specific price level that would constitute an institutional order flow entry drill. Institutional order flow entry drill is a entry model where you're expecting a fair value gap to be traded into, but not fully close in. And because you're expecting low resistance liquidity run conditions today, because of all the things I talked about in the first quarter of or first half of this lecture today, all those things building and coalescing with the idea that it's going to be a large range day, it's going to be explosive at the opening, any opening range gap should not be expected to be traded to, even though there's a 70% likelihood that half the gap should be repriced to in the first 30 minutes. Throw that to the sidelines and expect them to just really make a mad dash to get to the liquidity that we've outlined. So low resistance liquidity run entries in here, low resistance liquidity run entries here, and then this is a gap that is what? Below the upper quadrant. And this is where I would use to see if I'm on side. If you're listening to me, you're trading ends on the entries here or less. Anything above it, you're just using it for management purposes. So when this fair value gap forms, this is a valid fair value gap, but it should not fully close in. Why? Because we're in low resistance liquidity run conditions. We're in an early session of a potential large range day that's bullish, and we're at the upper quadrant and less. See that? So what does that create in here? This candlestick's low, that's an institutional order flow entry drill. That's an institutional order flow entry drill. That's an institutional order flow entry drill. Leaving what? Portion of the range open. That is telling you continuous feedback that yes, down closed candles consecutively, that's an order block. Draw that out in time. Hits it. Does it support price? Yes. In and of it by itself? Nope. Half of this gap at equilibrium and an order block, this portion should stay open. It should not trade back down to this one because that's a breakaway gap. All those things are signatures and characteristic of low resistance liquidity runs. When you enter in here, your stop loss can be just below this candlestick's high because it's not going to go down to the lower bottom of that fair value gap because we're in low resistance liquidity runs. The algorithm is controlling this. So if you know what the mechanism is going to be when it is seeing these things based on defining your dealing range, knowing where equilibrium is, if you're bullish, you're buying at it or below it, in every fair value gap, or in this case, order block. Isn't this an order block? Down, close candle, down, close candle. 2 consecutive down, close candles. That's all one range. It's doing what? It's delivering price lower. Does that down, close candle support price going higher when it comes back down to it here? Yes. Then price goes where? Higher. Down, close candles here. 1, 2, 3. And then it creates that final institutional order flow entry drill like it did here in this range here, going right below the high of the fair value gap. Same thing here. This candlestick's low. That's the high of this blue shaded area or fair value gap. So it's trading back down into that. When we're seeing price trade down into it, this candlestick here, isn't that an order block? And then the down close candle when price is moving higher. Inside that candlestick's range, it's trading down into it. And it's rare that it does this, but sometimes it will. It'll trade to the low of the candlestick. I don't like that. I would never enter on a trade like that. I want to see half of a bullish order block, the mean threshold or higher to its high. I want to see price use that portion of it to trade down into and then repel price away. When you're looking for dojis or tails beneath the candlestick, like we're saying here and here, those are forming inside order blocks or inside fair value gaps. When the order flow is bullish, you can anticipate these things forming. That's why when you look at my entries, I'm always entering on the very lowest candle or the one candle before or the one candle after the lowest candle when I'm bullish. Now the market then leaves this range and breaks above the dealing range here. And then we're going into what? We're going into that 9 o'clock hour. And we trade up into new week opening gap here. We traded up to just short of consequent encroachment of the new week opening gap. Now this is current new week opening gap. So here is the consequent encroachment of the new week opening gap. Now again, the new week opening gap is the difference between 4:59's closing price on Friday, Eastern Standard Time, to 6 p.m. Sunday, Eastern Time's opening price. And then the difference between those two price points, the halfway point, is this little dotted line right here, which is consequent encroachment. So we see it fail to get to it initially here, and then it drops down outside of the new week opening gap. Does that mean it's going lower? No. Then the market rallies back up and trades to the high of the new week opening gap. And then now what do you want to see happen? The market drops back down to some random level, stops dead in its tracks, and starts delivering price higher. And then ahead of 9:30, they run against those individuals that are on side. And all this movement here, even the Model 2022 guys, ICT stuff. Oh, this is a classic ICT Model 22. We have a shift in market structure. There's a fair value gap right there. It trades all the way back up to a premium. And then it's also optimal trade entry. And look at this. It's selling off. Yeah, look at that. Beautiful. If you didn't take a partial, your ass is handed to you. It's just being delivered back to what price level? Consequent encroachment. Consequent encroachment. Consequent encroachment. And then at 9:30, all hell breaks loose. Boom. Manual intervention. Yes, because the hand says we're not letting those buy stops off the hook. Rip and run. You see this delivery. You ain't gonna find nobody better, baby. So the rundown into consequent encroachment, ripping higher, is all part of this larger range delivery that has been encapsulated around Thursday creating an inside day. So there's a compression. And then we know there's a large range expansion on Friday likely to happen. And you want to be pre-market entry and then let it go. And then it trades up into the pools of liquidity that we were looking for. Here, gyrated around, came back down into pool liquidity here, relative equal lows. You see that? Trades lower, lower, rips, makes a higher high, and trying to get a little bit. Look how it's just meandering around. That's what I'm saying. If earlier in the beginning of the session, when we were trading up here, I said you would be done. If you're a morning session trader, if you're a day trader, you'd be done. If you're a position trader, a swing trader, you'd have 80% of your position off, and then see if it wants to continue going into the afternoon session. It may not. But at this point, if you haven't banked 80% of your run, you're doing it wrong. Okay, and that's how use pre-market session when you're anticipating a large range day. How do you anticipate a large range day? By looking at the last 3 trading days, getting the average of the last 3 trading days, and if you are closing today less than that average daily range, that means that you are in a small range day. That's mathematically defining something that is very simple. But if you want to break it down to 5 days average daily range, and if you start creating daily ranges that are less than the last 5 days, you are in close proximity to a large range expansion day. And large range expansion days are 90% low resistance liquidity run. So a small range, or that is that it's not a big explosive large range day on the daily candlestick. If it's not a large day, then you're probably going to be met with high resistance liquidity runs. Not all the time, but 90% of the time, large range days are low resistance. That means there's very little give back, and you can see it here. It's just like off to the races it goes, and it's just like go, 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 go. Another characteristic when you're trying to trade in low resistance liquidity runs, don't be in such a rush to take partials off. Manage those days by your stop loss. Don't be in a hurry to just pay yourself, because you're going to be like a deer in headlights. You're going to be scared because it's going to be running in your favor so fast. It's scary. If you've never made big money, if you've never been in a trade where it's just ripping and taking off and moving hundreds, not 10 handles, not 20 handles, not 30 handles, not 50, hundreds of handles in very short time, it's going to be very intimidating for you. So if you know that you're in a low resistance liquidity run days, move your stop to a reasonable level where you can just take a break and walk away from it. Have your limit orders in. If it hits your target, you're done. But walk away from it. Go do something. Take a walk. Go work out for 20, 30 minutes, and then come back. And you'll be rewarded for having been in it a little bit longer, and you won't be watching on in this case, a 15-second chart. Every little fluctuation and minor movement, it's going to scare you out of the trade. It's going to make you feel like every little possible retracement is the top of the marketplace. And without having an idea where the market's gravitating to, by having that reference points of those liquidity, remember on the 15-minute time frame, that's these highs here. That's smooth right here. High, lower high, lower high. This is a prime candidate for a run on liquidity. And you've been trained to look for that in price action. And look how this quickly ran right to it. That's not random. But that speed, that element of speed, is because of the day of the week phenomenon. They don't have a whole lot of time. They only have today until 5 p.m. Eastern time. Are they going to wait until the afternoon to get to there? No, they want to be done. They don't want people to sit there and think, oh, maybe I should square my positions going in the weekend because there might be something that happens in the Middle East and I wake up to gap risk on Sunday. They don't want that. So they intervene manually and boom, you get that. Doesn't this look like FOMC? Look how fast that ran like that. That's not algorithmic. That's intervention. That's what that is. Okay. How many lows did you see get retraced on in here? On a 50-minute time frame, 5-minute time frame, 1-minute time frame. I mean, shit, look, it stopped dead in its tracks at consequent encroachment twice. Here and here. It didn't take sell side. It's not interested in that. It's aiming for what? These suckers up here.